Hello and welcome to Portfolio Matters, week 58. And it's been a week dominated by tensions between Ukraine and Russia. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Well, before we get going, it's pub night again. And thank you to regular attendee, James Battle, for suggesting we move to a different pub. So we're moving slightly further down the road to the City of York. We'll try it out on Wednesday, the 9th of March. So hope to see you there. Okay, it was a volatile week in the markets, which was dominated by tensions between Russia and Ukraine. And today, Biden is warning that Russia is intending to invade Ukraine, including an attack on Kiev. Now, Richard and I, in other matters, have been reading for our economics book club. Yes, it is as nerdy as it sounds. A 550-page biography of Khrushchev, which has some relevance to the current situation because in the 60s, the late 50s and 60s, Khrushchev had realized how weak Russia was compared to the US. But he also realized that the US did not know how weak Russia really was. To give you an example, the Americans at that time were obsessed by the missile gap, and they thought Russia had more intercontinental ballistic missiles than the US did. The US estimated the Russians had 100. The Russians actually had 4. So Khrushchev's game plan in his dealings with the West, and he wanted essentially to get the West to withdraw from Berlin. His game plan was to put on an aggressive and brave face to try and essentially bully the West into concessions, while all the time actually wishing to avoid war and stepping back from the brink whenever war looked likely. And I wonder whether Putin is following the Khrushchev playbook. Richard?
Yeah, it's interesting, isn't it, Keith? It had, reading the book, it had so many shades of what Putin is doing now. One of the things that Khrushchev did was he basically chanced his arm and pushed really, really hard. But then if he realized he'd pushed too hard, he would pull back. And Putin is pushing very, very hard to see what sort of a response he gets. Now, his intention to invade or not, we can't divine, but he is pushing very, very hard indeed. And he's waiting to see what falls out. And it's entirely unpredictable. And of course, it's a scenario that is rife with problems and unexpected impacts. So very, very dangerous situation. And of course, Putin's today is this weekend, they're doing nuclear exercises.
Yeah.
So he's ratcheting up the pressure yet again. And clearly he has an objective in mind, whether it's to invade Ukraine or whether it's to rattle everyone's cage so hard that he sort of reasserts the position of Russia in the global hierarchy. I don't know, but it is dangerous.
Yeah, my prejudice is that I don't think he will invade. Frankly, to invade the whole of Ukraine with 150,000 troops, he just doesn't have enough. The moment he gets into an urban environment, he will get bogged down, and I think he knows it. So I think he would be foolish to invade Ukraine. But we don't know exactly what he intends to do. So the risks remain out there, and the markets are very volatile.
And he has put in place all of the logistical support to enable him to invade Ukraine. In other words, he doesn't just have attack units on the border. He has all the logistics behind them that would be required for an invasion to be successful. So he is putting in place the scenario where he's able to invade if he wishes, as Keith says, whether he could invade successfully.
Yes, but at the same time, Richard, nowadays with modern, satellite surveillance, he knows in order to bluff successfully, he has to, show that he really means it, and you can see his kind of build up in that context. Okay, moving on. The other news this week was that Italy is planning to subsidize energy bills to the tune of 8 billion euros this week. And the US is proposing to scrap federal gasoline taxes to lower fuel prices, which have become a political worry, all of which, frankly, just subsidizes demand. It does nothing to increase supply, as we have been discussing for many weeks on this show.
And further damages government finances.
Yes, absolutely. And when we talked about the Eurozone in some depth in the podcast last week, Italy subsidizing energy bills, we would be interested to see what the Northern Europeans do. And as you will see, as we go through the charts, the lithium price, which has been rising very strongly, has gone absolutely parabolic, up 10% last week. So you're trying to avoid high oil prices by buying an electric vehicle. You better buy it fast, because electric vehicle prices are going to be going through the roof as well. And this is from Bloomberg today. And Biden is saying that he thinks Putin will invade. Okay, going through some economic data this week. So, a reminder of our new policy. We're not going to go through all the data. We're going to highlight 3 data items. If you're interested in the rest, please pause the video and have a look. Okay, so the first 3 items we're going to highlight is UK earnings, which exceeded expectations. So expectations were for 3.9%, came in hot at 4.3%. And that is a wage price spiral in action. In the US, the big news was a very substantial miss in the consumer sentiment survey. So expectations were that consumer sentiment would improve in February from January, but it didn't. It fell sharply. So the expectations were for a reading of 67.5, and it came in at 61.7. And we'll show you the chart that shows that consumer sentiment is right down at its lows during the COVID crisis. And finally, US consumer inflation expectations were a miss. The Fed seems to be doing a good job at keeping inflation expectations low, because actual inflation continues to rise. So the consensus expectation was that consumers would be expecting 1 year ahead inflation around 6.3%, and it came in lower than that, came in at 5.8%, actually down on December. And that is good news, because hopefully that would mean the US workers would reduce their wage expectations and reduce the chance of a wage price spiral. Okay, charts, Richard.
Thanks, Keith. Germany CPI has just ticked down a little bit, but we don't know whether the trend has changed. Michigan consumer sentiment is on a downward trend at the moment, back towards the levels of a decade ago. Well, quite interesting, because it makes you wonder whether we are moving towards a sort of a more recessionary type of mindset.
Well, I think what's happening here is that consumer sentiment is being undermined by very high prices. So house prices, prices of cars, inflation, essentially, including asset price inflation, which is reducing their living standards. So wage gains are lower than inflation.
And as Keith said, consumer inflation expectations looking very much like the German actual inflation graph, actually. US building permits rising again and continuing their sort of upward trend since 2010. suggesting that at least the construction sector is fairly optimistic, and housing starts is showing a consistent increase year on year. New jobless claims has plateaued really at this level. It seems to be very stable now for the last few months. This is a weekly graph, and continuing jobless claims has also plateaued from really the beginning of the year, suggesting the jobs market is actually quite stable. UK unemployment rate is down at 4%, which is basically the lowest it's ever been, I think, isn't it, Keith? Give or take.
Yeah, that's very good, actually. Almost completely healed the UK job market. And considering we've only really just come out of COVID restrictions, that's pretty astonishing.
UK earnings growth, including bonuses, this is quite a hard chart to interpret, I would say. What do you think it tells us, Keith?
Well, it's year on year. You're right, Richard. So, it's distorted by the kind of falls in earnings during the early stage of COVID. But now that those numbers are dropping out, if you look at it over the last 15 years, I mean, that is quite a high number. And, we've just seen that unemployment is low and we're just coming out of COVID restrictions. And I think watch that number, because we know that inflation is higher than that. And you'd think with tight labour market, employees have pricing power. So something we'll watch over the coming weeks.
Yeah. The EU economic sentiment indicator above the zero line, not looking relatively healthy and stable at that level, I would say.
Yes, I frankly, I thought this was a really amazing and impressive number. If you look at this chart over the last 20 years, you'll see that actually that number is better than the whole of the economic cycle, last economic cycle, and pretty much the previous one as well. And it's actually economic sentiment was lower pre-COVID than it was during COVID.
Yeah.
Odd.
And apparently unaffected by inflation.
Yeah. Okay, on to Inflation Watch. And we had this week UK numbers. It came in slightly above expectations at 5.5%, core at 4.4, RPI 7.8. Remember, RPI is the old way we used to calculate inflation. And reminder that the US has inflation of 7.5%, and they are still currently printing money. That doesn't end until next month. So they're still easing.
Services inflation at a 30-year high, as the chart says. If they pick up to where they were in the late 1970s, early 80s, they've got a long way further to go yet. We shall see. But it's interesting that they're significantly lower than the goods inflation rate, aren't they, Keith?
Absolutely. Well, I think the point is, Richard, that previously during COVID, we had a great deal of goods demand a great deal of goods demand and load of goods inflation, but it's now broadening and seeping through into services. So watch this space.
Rental inflation, it's been quite a lagging indicator, particularly because of the way it's measured, but it is actually rising quickly now. And as we see, it's pretty much at a 30-year high, so approaching the 30-year high, and in a very dynamic manner. I would say it'd be very unlikely if it doesn't break through that.
I agree. Although if you look back to, actually this is pre the great financial crisis, it was rising very quickly then.
Yeah.
But equally came down quite quickly because of the great financial crisis.
Right.
So
Yes.
that's not a precedent we want repeated.
No. Is that the solution, we ask ourselves?
Well, this is a nice chart because it shows wage inequality is coming down. So the wages of the bottom quartile of earners are growing the best part of 6%, while the top quartile is growing at less than 3%. So very good for inequality and actually for future demand.
Wow. So shadow stats. This is an alternative method of calculating inflation. Says that US inflation is above 15%. Now, actually, I personally have some sympathy for the shadow stats methodology. And I'm not saying that it's spot on, but I think that I suspect the true rate of inflation is somewhere between what the official rate is and what shadow stats say. And
Well,
I think to an extent, it depends upon your lifestyle and where you sit in the socioeconomic scale as well.
well,
Keith doesn't agree.
I included this chart, Richard, because I knew you'd love it.
Thank you. I fell for it, hook, line, and sinker.
But anyway, I don't know enough about how shadow stats actually calculate their number, but I just don't think it's credible that you can say we've had inflation of 10% for the last 2 decades, because you wouldn't be able to afford anything, if inflation had outstripped wage growth by that degree over the last 2 decades.
Yeah, I think partly, without dwelling on this too much, partly they take out the hedonic adjustments and so forth, don't they, here?
Right.
So that you're not really comparing like with like, and then you can debate about what hedonic adjustments are appropriate, what aren't, and if the price of sirloin steak has gone up, can you substitute it for chuck steak or something?
Yeah.
And which is what happens with these adjustments.
Mm.
So I don't know is the answer. And I think, as I say, it very much depends on where you sit in the socioeconomic scale and your consumption pattern.
Mm. So the Fed's preferred inflation measure is personal consumption expenditure inflation, and forecasts for this year just keep on getting higher. Now, which is interesting in the context of US consumers' inflation expectations actually coming down.
Well, wage growth, 3-month moving average median wage growth is showing a dramatic surge in US wage growth, as one would expect if we are moving towards a wage price spiral. And it's looking quite dangerous. And changes in CPI rents have been much smaller than changes in house prices for now, which we know because we know that they do this owner equivalent rent thing for calculating rental inflation, and it doesn't really work, and it's bizarre and doesn't take actual market data, and it is very much a lagging indicator. And this is more like the leading indicator of the up-to-date indicator of what's happening to rental prices, which means that the CPI is significantly understating rent inflation. Yeah,
I'd expect the rental component of CPI to start catching up, because it's only got inflation about 5%.
The other point here, Keith, is that this is something that renters are experiencing now. And if your rent goes up by 15%, which I think this is telling us in the last year and a bit, and rent is a significant chunk of your monthly outgoings, like 50 or 60%, then you have to have a pay increase or you go bust, you go bankrupt. So this is a huge impetus for the wage price spiral that is not within the data as being disclosed by the Fed.
No, I agree with that, Richard, but I would caveat that by saying that this chart shows asking rents, not actual agreed rents. So
that is true.
We have to be slightly careful, but the general point I think is, right, because asking rents are a good predictor of CPI rents, although not perfectly, but pretty good.
This is the rate of change of central bank money. Basically, it has now settled down to no change approximately. They are not collectively printing. So
you'd think that if you believe that inflation is always and everywhere a monetary phenomenon, as Milton Friedman would say, you would expect that inflation should start to come down. But of course, we don't believe that anymore. And on that note, how persistent is inflation? So this is an interesting set of charts from John Authors at Bloomberg. And what it shows is inflation now plotted against inflation in 3 months' time. So x-axis inflation now, y-axis inflation in 3 months' time. And unsurprisingly, there's a very strong link. If we now look at just the data when inflation is greater than 7%, so x-axis is inflation now, y-axis inflation 3 months later, you'll see, and inflation in the US is now 7.5%, that the results in 3 months' time are very heavily skewed towards higher inflation. So when you have high levels of inflation, more extreme outcomes become more likely. Now, I realize a lot of this data is from around the world, but it is perfectly possible to have inflation spiraling out of control. And we know that underlying inflationary pressures continue to rise. New policy, by the way, whenever we do one of these special sections, we're going to put in our conclusions. So we conclude from that inflation is likely to be persistent, and above all, that the bond market is being extraordinarily complacent in assuming that inflation is transitory, and there's therefore the danger that the bond market suddenly wakes up and real yields start rising very quickly. And on that note, can bond prices predict inflation? So this is a chart. The blue line here is the 10-year Treasury yield, and the pink line is subsequent 5-year inflation. And the two aren't very well correlated. So it would seem like in the 70s, the bond market lagged inflation, and it then became incredibly conservative and expected too much inflation and continued expecting too much inflation for 35 years. Obviously, this chart ended 5 years ago because we don't have data for the subsequent 5-year period. The last 5-year period we have is one ending in 2017. But the point of this chart is Treasury yields don't forecast inflation very well.
Yeah, I remember a few months ago we showed a chart, I think it was from Lynn Alden, where she had done she'd done the future returns from bonds versus the inflation rate. And they basically didn't correlate with the two didn't correlate, and suggested that the bond market doesn't. Despite what everybody says that the bond market is the great seeing eye, the bond market doesn't actually correlate with future inflation.
Yeah. And on that note, so this is the blue line here again is the 10-year yield, and the pink line is CPI year-on-year change. And you can see now that the bond market has hardly moved, whereas inflation has gone through the roof. Now, is that complacency warranted? So a lot of commentators are saying, well, you don't need to worry about inflation because the bond market is super smart and it's relaxed about inflation. Therefore, because it's smarter than you are, you shouldn't worry either. Well, these charts seem to suggest the bond market ain't that smart. It's just slow to react.
Particularly as we've spent a long time, Keith, you and I, discussing how the bond market is effectively manipulated by central banks.
Very true. So, in conclusion, Treasury yields just seem to have been slow to react to changes in inflation regimes, and the current low bond yields do not necessarily mean that inflation rates will fall back to pre-COVID norms anytime soon.
So the US mortgage rates are rising quite quickly, and they've gone up over 1% in the last 6 months. And the That is actually, if you go back to August 21, they've risen from, let's say, 3% up to around, let's say, 4%. So that's a 30% increase in 6 months, which is a very dramatic rate of change. And you would expect it to have an impact on the affordability of mortgages and therefore the prices of houses. We touched on this a little while ago, and Keith has prepared this graph, which is really interesting, that basically it says that if you have £1,000 to spend a month to spend on a mortgage payment, principal and interest, i.e. the total servicing cost, how much can you afford to borrow? And if the interest rate is 0% and you're repaying your debt off over 25 years, you can afford to borrow £300,000. If the interest rate is 10%, and a lot of your debt servicing each month is going to pay interest, not pay off principal, you can afford £110,000 maximum mortgage. So if the mortgage rate is 2%, you can afford a property of around about £240,000 on the above assumptions. If the mortgage rate goes up to 6%, you can only afford a property price of £150,000, which suggests there is around about, if interest rates rise to 60%, suggests the property market should fall by around about 30% on the basis of affordability, which is a very big drop and would leave a lot of borrowers, property borrowers in Europe, the US and the UK in negative equity, and would damage the price of properties, which is what we are starting to see in the US, as this graph shows. And this graph shows that US house building share prices are underperforming the market, probably because the market sees that house building might get a bit tough with we're now moving into an increasing interest rate environment. Total US existing home sales are in a fairly rapid decline, which is still contradicts the next chart, which shows the US housing starts.
Well, I don't think it does contradict it, Richard. I think it partly explains it.
Right.
So you wonder how much of this is due to home working. Because if people are home working, they can work from anywhere. They don't have to move as much.
Yeah.
And also it increases your desire to live in a nice house. If you've got a nice house, you keep hold of it. It may also partly explain this chart, which shows that building starts in the US are the highest since they've been since 1963. So presumably people, if they're working from home more, want to have a bigger and nicer home.
But it suggests that house builders, if interest rates go up, affordability drops, construction costs are rising, suggests that house builders may be in for a bit of a difficult time. Absolutely.
In particular, they've started building a load of houses when interest rates are rising. And you wonder whether they will actually manage to achieve the prices they had expected, and as a result, whether they're overbuilding.
So our conclusions in summary are that rising interest rates have to be bad for house prices, which I think intuitively we all know. Rising house prices were bad for house builders and their suppliers. And house builders may be overbuilding and may in fact end up with a balance sheet problem, in that they will have borrowed to build and they won't be able to get rid of their inventory. Similar, but not at such a large scale, to the issue that China is experiencing. But we don't know yet. We have to watch this space.
Yes. Okay, next section. What effect would war in Ukraine have on asset prices? And I thought this was a really interesting table from John Authors at Bloomberg, showing the effect on the S&P 500 of various crises throughout history. And you'll see, so Pearl Harbor caused the S&P 500 to fall by just 3.4% over that month. And over the following year, it was flat. So, and what you notice going through all these is that actually the only ones to cause lasting damage to the S&P 500 are the ones where the oil supply was in some way disrupted. So Suez Canal caused the the S&P 500 to lose 11% over the following year. Oil embargo down 36%. A lot of these, even when there was oil disruption, the S&P 500 did okay. So the Iran hostage crisis, S&P ended up 24% of the following year. But the key takeaway from all this is that actually a lot of the fall in the S&P 500 tends to fall in advance of the crisis. And when the crisis actually occurs, it removes a lot of the uncertainty and the S&P 500 can actually rally. I mean, the biggest example of this was the Gulf War, where everyone was expecting loads of disruption. The Gulf War would disrupt international oil flows through the Persian Gulf. And when that war actually broke out, and it became very clear very quickly that the US and its allies were going to win and there wouldn't be much disruption, the market rallied very strongly and ended the year up 33%. So actually, war in Ukraine needn't be bad for asset prices. Richard.
Yeah, I think it's what would be interesting, I don't know what they would show, is if you're stuck in the Second World War, the First World War, globally engulfing crises. None of these actually were globally engulfing crises as it happened, although the Arab oil embargo probably was. But all of the others, relatively minor in terms of their global impact. Actually, the World Trade Center, you might say, sorry, 9/11 was actually globally engulfing because of the consequence of it, wasn't it? So I think maybe you have to look at it in that sense of what was the spread of damage throughout the globe. The unknown about a war in the Ukraine, a Russia invaded Ukraine, we don't know what the spread would be. We will only know that after the event, should it happen. But the Russian invasion of Afghanistan, well, pretty much irrelevant to us, I would say, to the West.
Yeah.
Good for arms manufacturers.
Yeah. Well, you'd say, Richard, that do you think if they do invade, how much contagion do you think there's going to be? I mean, they're not going to keep on going over the border to attack Poland, because that really would be world war. I think it'd be. I agree. I agree, Keith. It's not. I don't think it's going to cause an awful lot of diplomatic fuss, sanctions, etc. But I don't think it's going to be globally engulfing at all. I don't. So yeah, I think that is the take home, isn't it? Yep.
It's relatively minor, geographically contained.
So, in summary, if history is a guide, the war in Ukraine needn't actually be terribly bad for equities unless it disrupts global energy supplies. And most of the losses to equities may have already occurred.
So we're going to run through some agricultural commodities prices now. Coffee is up 250. Well, a lot anyway. since for the last 12 months, it's massively risen, hasn't it?
Yeah.
It has more than doubled.
150%, I think we'd say.
Slight mind block there. Corn, it's gone up from 300 to 600, so it's doubled with a spike in the middle of 2021. Soybeans gone up from 800 to, they've doubled, haven't they? Over the same period of time. Wheat, since the beginning of 2020, has gone up only relatively small from amount, actually, from beginning of 2020, from 600 to 800. So that's only 30% rise. So it's quite benign. Cocoa is actually pretty much flat, but very volatile. Palm oil has gone up 150% plus. Oats, 150-ish% there. Sugar, 80%. Orange juice, that's up 40% since 2020. Cotton has gone up, is up 150. A lot of these are 150%, aren't they, Keith?
Actually, this is just really about 100%, but still coming to
50 to 100. With respect, 50 to 125 is 150%.
No, you're right, but it's kind of that was a brief spike down. Yeah. Anyway.
And the food commodity price indices, which we haven't shown for a few months, is really quite alarming. We talked about this, I think, probably in the autumn of 2021, where at what point does food price inflation start to cause social instability?
Yeah.
And we're clearly moving in that direction. And the other thing I would say on this is that if you take, let's just assume that that's 15% rent Zillow index that we were looking at earlier, 15% on food, on that 50% roughly on food prices, and you take someone who is on a relatively low wage, that means that their experience rate of inflation is high, and adding energy is high. It's not a few percent. It's not single digit percentage. It's more than that. So it's very difficult to see how we do not move into a wage price spiral at this stage. The rich can afford it. The sort of average family can't afford it.
I wonder how much of that they can explain away with hedonic adjustments, though, Richard. Yeah, the beans are better quality than they used to be.
Yes, it's just as good protein as a nice steak.
Mm.
We heard it here first.
And while we're talking about commodity prices, I didn't know this, that Russia has put a ban on ammonia fertilizer exports. And one of the things you see during a commodity price spike is a lot of commodity nationalism, with people refusing to export fertilizer or cotton or whatever they need.
I think this is interesting. I wasn't aware of this, but if you take this in conjunction with our earlier discussion about Ukraine and the effect of Russia, so I do think that Russia is actually stronger than people give it credit for. So it has very significant cyber attack facilities capacity. It regularly takes down Ukraine, but I think it could cause huge problems with cyber attacks in the West. And it has a stranglehold on gas supplies to Europe, who are totally dependent on Russian gas, or not totally dependent, highly dependent on Russian gas supplies. It is far less dependent on, as we discussed last week, I think, on its exchange, on its foreign exchange reserves. It has a lot of gold there now, and it's replaced the dollar with gold. And it is forming an alliance with China, and it has a fairly significant strategic alliance with China. And in many respects, China and Russian interests are aligned, geopolitically aligned at the moment. So the situation, I think, is potentially more dangerous and more convoluted than simply Russia moving into the Ukraine and having a few sanctions imposed on it. So our conclusion: food price inflation shows no sign of showing, and therefore unrest in EM. And I'm not sure whether it's just EM really, because inflation is so high in comparison to wage increases at the moment in many countries, not just EM, that certain sectors of the population will get really hit very soon. Yeah,
we have already had one revolution due to rising commodity prices in Kazakhstan, and we will keep a running total.
Yes, interesting. And of course, Italy has forestalled a revolution due to rising energy prices, as we discussed earlier, with its 8 billion subsidy of energy prices.
By spending 8 billion, it's probably going to get from the ECB. Marvelous.
Yes, well, from Germany, I think. The Germans don't know it yet.
Exactly. While we are on agricultural commodities, we were contacted in the week by one of our regular viewers, Hugh, who is a farmer, and he was questioning our potash chart from last week, which I have double checked. It comes from the NASDAQ, and it shows the free on board price of Vancouver muriate of potash, that is potassium chloride. And this chart shows that the potash price has not moved at all. But then he said, he knows what he has to pay for potash. And he pointed me to this table, which is the UK price of potash. And you can see muriate of potash here, December 2021 is £532 a tonne. And that is up 120% on the year. And the UK price is the equivalent of $720 a tonne. Now, we have just shown you a chart, which you showed last week, and the data is to November, but it shows perfectly flat prices through 2021 of $221 a tonne. So the UK price is 3.5 times higher. Now, what on earth is going on? Now, this is really, really important. If anyone knows what's going on and why this isn't being arbitraged, please can you get in touch? Because actually we did a whole analysis on a potash development in Morocco by the company Emerson, in which I stated that the UN Food and Agricultural Agency was saying that potash was in oversupply, and we used that chart showing the Vancouver price of potash going nowhere to justify the fact that we thought the Emerson was not a very good investment. Now, if actual UK prices have gone through the roof, and that presumably that means European prices have gone through the roof, that implies that there's not much arbitrage going on around the world. And actually, if supplies from Morocco, which are much nearer, could supply the UK market, then Emerson, for example, could be a very good investment. So I'd like to know what's going on here. Why are prices in Vancouver so much lower than in the UK? It doesn't make sense. If anyone knows, please get in touch. And thank you very much to Hugh for bringing that to our attention. Okay, other charts.
Economists are downgrading the US economic growth for 2022. I think that's appropriate. There was an article in the FT this morning that said February 2022 year-on-year retail sales growth was 3.5%, but we have inflation of above 5% and annual inflation above 5%, which means in fact that real retail sales have dropped by 1.5 to 2%. And that is an economic slowdown, not growth. And I think one of the issues we actually have is that the economy appears to be doing better because people are thinking in nominal as opposed to inflation adjusted numbers. So I'm actually not surprised to see this graph.
That's a very good point, Richard. But actually, nominal growth really matters. So even if the real growth is 0 and nominal growth is, let's say, 5%, that erodes the debt burden very nicely. And I suspect that as long as people remained in employment, central banks would be quite happy with that, actually.
Yeah, you may well be right, Keith. The problem is that businesses become less profitable in real sense. So businesses become less profitable, and they can't afford to operate. Either their profitability drops significantly, or they move into loss making, and then they go bust. And so, I mean, if you say you have an inflation excess and you need to get rid of inflation, well, the way to get rid of inflation is via a recession. And what we may be seeing is the beginnings of that recessionary effect if profitability of businesses drops through prices being higher than they're able to recover, their input costs being greater than they're able to recover.
I would also say that we know consumers have savings, that wage growth in nominal terms is quite strong, and that now that all the restrictions are over, I fully expect people to want to enjoy themselves. So I still expect quite strong GDP growth this year, but there are, as you point out, headwinds from rising interest rates and above all, rising energy prices, which all take money out of people's pockets and are headwinds. And while we're talking about rising energy prices, this is the chart of French energy prices for 2023, i.e. next year. And you'll see they have been relentlessly rising. So we have disrupted gas supplies, we know, and also the EDF have cut their forecasts for nuclear power production next year. So this all adds to a picture of disrupted energy supplies in Europe going forward and persistently high energy prices, which will take money out of consumers and businesses' pockets. Now, we have covered previously how central bank largesse has meant that consumers and corporations have more cash than they had pre-crisis. And I thought these were good charts from GavCal. And the top chart is households, and you can see that their cash holdings are up. What's that? 25%. So pre-crisis, that's very good. Corporations also hold more cash, and banks have more cash compared to liabilities, so have the potential to lend more. All of that shows that businesses and consumers have resources to spend, and that should support economic growth if you can persuade them to actually spend it. And given now you've taken all the restrictions off, hopefully that will happen naturally.
UK living standards are under pressure. So this graph is showing the average weekly earnings in the grey bars, and then the 3 month average, moving average, and then we have where it's forecast to go. And what we're seeing clearly is that inflation is greater than earnings growth, and people are becoming less well off as a consequence.
Absolutely. And given a tight labour market, tight and tightening, you'd expect that workers would start demanding above inflation pay rises to at least maintain their living standards. And the chairman of the Bank of England, Andrew Bailey, recently got in trouble when he suggested to UK workers that they should be kind of restrained in their wage demands to for the good of the economy, while himself earning £550,000 a year compared to the average wage, what is it, 25, 30? Anyway.
I find it extraordinary that he's so ignorant, that a man who occupies such an important position should fundamentally be so ignorant of the lives of the people of the country. I think it's a disgrace. I just think it's a complete disgrace.
I think he's with the times, Richard. You know, he's don't do what I do, do what I say. And actually, to be fair to him, what matters is the change in wages. So if he, he could set an example by cutting his wages. Actually, that we should write to him.
I think it's a reflection of the times in which we live. This is a "don't get me started" moment. I think
it is, isn't it? Anyway, you heard it here first, Andrew. You should set an example. You know, cut your wages a bit.
The surge in shipping costs seems to have slowed. It's early days, isn't it? But the very steep increases just appear to be levelling off. We shall have to wait and see. But as the comment says, there's no sign of them yet dropping, which means that whilst if they do level off, their contribution to inflation will fall away, but it won't go negative.
Now, one thing I don't understand is how the Baltic Dry Index has collapsed when we're seeing container rates remain extremely elevated and are not coming down. If anyone can explain the difference between container rates and the Baltic Dry and why they're showing such different patterns, please get in touch.
Can I offer a speculation briefly that the Baltic Dry Index is an index of ships that effectively carry non-containerized dry goods such as grain, muriate of potash, iron ore, and that the loading and unloading of those is different to the loading and unloading of containers.
Ah, okay. Now, this is something we're going to be watching going forward. And what this shows is the US 2-year yield minus the 10-year yield. And you'll see when this is inverted, i.e. goes above zero, a recession tends to follow within 2 years. Although, how the yield curve managed to predict the COVID pandemic, we don't know. But anyway, it has extraordinary powers.
We were just saying how effective the bond market is at predicting.
Exactly. They have Nostradamus-like powers. Anyway, but you'll see it is heading towards zero. So that is something we're going to be keeping a close eye on. And there is no COVID section. Hurrah! And long may it disappear. So on to equity markets, Richard.
So equity markets didn't have a good week. They're all down between 2 and 4%. I think Ukraine, as we discussed earlier, I think the Ukrainian crisis did unsettle them a little bit. Then we have Bitcoin had a bad week and has had a bad year so far. And the pound was up a little bit against the US dollar, which is good for the pound. And I'm not quite sure why that happened. And the dollar index is pretty much unchanged year to date.
Yeah. Well, I noticed, Richard, that the store of value called Bitcoin massively underperformed gold in this crisis.
Yeah. I guess we come on to gold in a moment.
Now, last week, we showed this chart on the right, which is the classic chart of a bubble. And I'd just like to draw your attention to the NASDAQ, which has had this nice little bump here, which perfectly coincides with the return to normal phase of a bubble deflating. And if the chart on the right is to be followed, fear, capitulation, and despair are soon to follow. You heard it here first.
And a very significant drop in the NASDAQ.
Yep, absolutely.
Like halving or something.
Yep, and this chart shows the sell-off in companies that report earnings misses. And you can see the market is really punishing them, particularly, and I think this really relates to the previous chart, because if a company in the NASDAQ misses earnings, the share price really gets hit. We saw Palantir was the latest one this week. Shares price down 25%, I believe. And finally, investors are starting to cut their tech allocation. So the light blue bars are investors' allocation, net allocation to tech. You see, finally, after years of investing in the NASDAQ and tech companies, they started to withdraw money. Although it is still the most crowded trade. Although slightly less so.
Time to start buying travel companies. This is an intriguing one, isn't it? I mean, on the face of it, yes, I would say. But there is this large looming problem is, what if we have a variant that comes along and causes huge travel disruption again?
Yes, I don't even want to think about that, Richard, but I'm currently working on our final batch of Share Talk updates, and included in that will be Saga, the UK insurance and cruise company, and I have been buying more of it recently. So, let's hope this gap here is going to close. Okay, on to energy commodities. So, oil had a good week. European nat gas continued to drift off, but remained very elevated. Coal has had a fantastic run, up 37% since the start of the year. Was that 7 weeks ago? And it drifted off a tiny bit this week. Uranium flat. Now, on to the crude oil numbers that matter. And last week, i.e. the week ending the 11th of February, which is the last date I get free data for, we had a drawdown in US inventories of a massive 12.5 million barrels. So that is continued drawdowns in the US and very supportive for oil prices. US crude production was flat on the week, but the Baker Hughes rig count, so the number of oil rigs at work looking for oil in the US, rose strongly, rose by 19 in a week. So is shale discipline starting to crack? And this is the oil price, which remains elevated. You do wonder where, if Russia decides to pull back from Ukraine and all the tensions disappear, how much of a fall there'd be, because there clearly is a geopolitical premium being added to the oil price at the moment. Now, last week we showed you this chart, and we were commenting then about, why on earth does OPEC think that demand is going to fall in the first quarter, and which is behind their forecast for an oversupply, fall in inventories, and a fall in the oil price.
Yeah.
Well, this week, the IEA, which is funded by OPEC, came out with these demand revisions. So they have revised back their historic and current numbers for oil demand, having re-evaluated petrochemical demand in Saudi Arabia and China. And these are big revisions upwards. And that brings IEA supply and demand forecasts more into line with market experience. But moving on to the energy transition, this was an interesting chart from the FT, and it showed how much investment would be required to achieve 500,000 charging stations in the US by 2030, and it's a big number, 39 billion. So, the energy transition will not be cheap, and you question whether sufficient investment is going in to achieve it, frankly. But going back to oil, these are the inventory numbers. Inventories are falling both in the OECD and also in the US, and that is supportive of oil prices. And as a result, the futures markets are in the highest backwardation they have been since 2014. So the futures market is expecting tight oil markets going forward. And a reminder, this is the seasonality chart, and we are here. So we would have expected oil prices to be falling in the first weeks of the year before seasonality kicks in and oil prices start rising. Now, actually, we've had rising oil prices, and now seasonality will kick in. So the oil price could well rise further from here. These are Dutch natural gas futures, and they've come off, but obviously geopolitical tensions are keeping them high. And it's not so long ago that they were below 10, and they're now at 70. So European energy prices will remain elevated as long as this continues. And Russia has cut its supplies via Ukraine. So black is actual supply. The pink is capacity they've booked and then not used. So this partly explains the high European gas chart. And this is coal, which remains elevated, and uranium, which is going nowhere. Richard.
So commodities had a very mixed week. Aluminium was slightly down, but very much up on the year. Cobalt was had a good week. Copper was really pretty much flat on the year. Going a bit. Iron ore down 11%, and that is a big drop. And we've speculated as to why iron ore was doing very well and year to date, and now it's not doing so well. Lithium, as Keith mentioned earlier, is having an astonishing run up. I think it's speculative demand. Of course, there isn't enough lithium at the moment to enable all the batteries projected to be made for electric cars to be manufactured. Magnesium is falling back quickly. Neodymium is also on a surge with its usage in, particularly I think in wind turbines and electric motors and powerful magnets. Nickel is continuing its steady run up, as is tin, and ferrovanadium had a very good week and is up 30% year to date. We have aluminium, which is on a good uptrend. This shows that aluminium inventories are low and continuing to fall, which would explain the increase in price. Then we have the London Metal Exchange stocks of aluminium, which are falling significantly. Cobalt is moving back up, a very important battery element.
You notice that all the green technology elements are moving up strongly.
Copper really is pausing after its very good run, 18 to 6 months ago, and it's now pausing. And we've got a lot of copper depletion going on, which is coincident with the expectation that the copper market will go into deficit at some point in the late 2020s. And copper inventories are low and falling fast. It suggests copper may be ripe for a bit of a tick up, doesn't it, Keith?
I hope so. I mean, of all the green metals, it has really lagged recently.
Chromium, iron ore. It's difficult to know what's going on, particularly. Lithium, well, it's going to price itself out, isn't it?
It is. I mean, that is an absolutely amazing chart. It is up over 8-fold in what, less than 18 months? Now, we have a few charts to try and explain this. So the blue line is Chinese electric vehicle sales, and you can see they have really taken off in the past year, and that is coincident with the rise in lithium carbonate prices. But the lithium supply is due to surge in the coming 3 years. So we look in supply in 2021, and so the different colored bars are different forecasters. But you'll see, we say the average in 2021 is about 400,000 tons. Well, over the following 4 years, average analyst is forecasting that production would go up 150% to about 1 million tons a year. So will that be enough to balance the market? Well, analysts remain split. There's a big divergence in opinion. So in 2025, a lot of the analysts are forecasting that there will still be a deficit. And behind those forecasts are explosive growth forecasts for electric vehicle demand. But a reminder that lithium only represents about 7% by weight of an electric vehicle battery. A lot of the rest is nickel, actually.
So this is showing the price of neodymium, which is on its just continuous upward climb, like as Keith says, as with most of the battery metals, the transference to clean energy elements. Nickel doing the same thing. Tin, we still don't know why tin's doing this, but it's continuing to climb.
Yeah, tin is in structural deficit. And as soon as I finish doing these Share Talk updates, I'm going to start analyzing Afritin, which is one of the few listed companies anywhere in the world which has got a new tin mine.
Ferrovanadium climbing back up towards its summer 2021 highs. And precious metals had a very good week, apart from rhodium. And there's, I think there are two coincident effects. There's obviously the concern over the Ukrainian situation, and there's concern over the persistence of inflation. And I think the consequence was that they all spiked up on speculative, well, not necessarily safe haven, I should say, safe haven demand.
Yes. And I should note, Richard, in contrast to Bitcoin, which fell.
Yeah, absolutely. Very noticeably. So we have gold approaching its summer 2021 high.
Now, this is just odd. Don't understand this. So rising rates should increase the cost of holding gold.
So I think it's a reflection more of people's concern that rates are rising because we're moving into an inflationary environment, and therefore gold is a good to hold in an inflationary environment.
Yeah, possibly. But I also wonder, Richard, whether, frankly, the FT have chosen the timescale quite carefully, and whether this last pick up here in the gold price is more related to tensions in Ukraine than it is to rising rates.
It's a very short timescale graph. Not much to say on silver. More platinum.
Generally a decent week for precious metals. Okay, and finally on to rates. Now, this is interesting. So, tensions in Ukraine caused safe haven buying of bonds. So, UK yields fell across the curve as investors rushed to safety. But they didn't do that in the periphery, where bond yields continued to rise. So the Greek yield, the 10-year yield, hit 2.54%, and the Italian yield also continued to rise. So that continues to be a concern. Now, this chart shows the thick line is the actual federal fund rate, and the squiggly lines are market expectations for the federal funds rate. And you can see the market has been not a very good predictor, and this is the current forecast. So, they're forecasting strong rate rises imminently. But then if we look at the Fed's forecasts for its own interest rates, they're no better. So nobody is very good at forecasting interest rates. Relating to that, this is the price of the peak of bond market stupidity, the Austrian 100-year bond. And the scale on the right is the price, which has halved in just over a year. This is the Greek 10-year. It's come off a tiny bit in the last couple of days, but that is not a happy-looking chart. We'll see how this goes. This is Italy, UK, safe haven buying the last few days, and same in the US. And this is finally the seasonality chart, and bang on cue. See, the seasonality chart is all-knowing, Richard. It predicts that actually Russia won't invade Ukraine, or if they do, they'll do it at the end of February and markets will jump up. See, Nostradamus-like powers. Anyway, what have you been up to this week?
Thank you, Keith. So my weekly change, gold had a very good week. It was up 4%, but for some reason that slightly escapes me, I had a much less good week, only up 0.3%. And I have been following Keith's mantra also of investing in oil stocks, and the oil stocks didn't have a particularly good week. So it was slightly swings and roundabouts for me, with my gold, precious metal shares doing well, and my investments in oil companies doing less well. And so my change of the year 2.4%, and I am outperforming the FTSE all share by 2.7% at the moment. I'm hopeful that my precious metal shares will start to move. The other week, someone made an inquiry on a Discord channel about the Advisor Shares Pure US Cannabis ETF, which I mentioned a while ago, and I noted that it was in this downtrend, and I was watching it to see if it broke out of the downtrend. Well, I'm still watching it, and it did break out of the downtrend, and it's now come back to the top of the downtrend line. I don't think there's any rush to enter this trade at all. I'm not aware of any particular sort of political moves in the US that would make it a better trade than it otherwise would be. And so I am actually just interestingly keeping an eye on it. And we shall see, but not for now. This I found interesting. So last week we talked a little bit about one of the ways the EU could get out of its ghastly, the ECB could get out of this ghastly bind of not being able to raise interest rates because governments will go bust, and the huge level of indebtedness, and the fact that Germany is basically on the hook for all of the EU debt. We mentioned that one possibility would be for the EU to revalue gold. Obviously, it couldn't do it on its own. Gold would have to be revalued by all the world's central banks. But I came across this. This is Jan Newhuis of the Gold Observer. And he sent a letter to the Bundesbank, which basically he said, are you considering revaluing gold reserves in order to get out of this situation? And the answer came back, you can read the answer there, which basically says, we prefer not to speculate about any potential decisions that might or might not be taken in the future. In general, the ECB guidelines are decided by the ECB Governing Council in accordance with the limits set by the European treaties. In other words, what he's saying is they didn't say, of course not. They gave a rather equivocal answer.
Yeah.
So that is interesting. And I thought it was worth putting in here. And this is just a chart I came across this morning, actually, so I just popped it in mine. And it's the Wall Street winning, Main Street losing. And look how big the excess valuation of financial assets as a percentage of GDP is in comparison to what it was for the 40 years after the Second World War. And if we're talking reversion to the mean, it's hard to know where the mean might actually be on this chart because of its shape. But reversion to the mean would be fairly painful for US private sector financial assets.
Yeah. Well, what is the fair price of Peloton, Richard? Yeah.
Well, probably not as much as it is at the moment. I was looking at I've got a chart set up for each of Cathy Wood's 6 ETFs. And they have each bounced off their rather precipitous fall. And now the bounce is over and the price is back down to the point at which they bounced from. They do look like they're going to fall off again, substantially.
Yes. Reminder to all viewers, as we've been saying regularly in the weekly, that we think that growth companies will really struggle as interest rates rise and there is no bottom. So don't buy the dip.
Buy ARC when it's dropped 90%.
Yes. And then wait a few months.
Yes, just in case. In case it drops 95 and you lose half your money.
Precisely, right. Yeah. Okay, thank you, Richard. Well, I had an indifferent week, down 0.9%, as my energy companies went nowhere to down, despite the oil price actually going up. But I've had a very good start to the year, up 9.3%. Now, I did actually do quite a lot of trading during the week, as I was sat at my mother-in-law's house, and I could, when I was bored. So I sold Tullow Oil, which has been very disappointing. Now, Tullow Oil have enormous debts, and they have big oil fields off Ghana. Now, we're having a discussion on the Discord, and thank you to Simon W. in particular for his comments, but I was prompted to dig through the last annual report, and I found a section which I'd missed on huge potential legal liabilities. They're in dispute with various tax authorities, and if they lose, their debt, already substantial debts, would increase by $1 billion. And bottom line is the oil price has been going up and Tullow Oil hasn't. So decided to sell. It's crystallizing a loss of 11%. Genel Energy have assets in Kurdistan, Iraqi Kurdistan, and essentially the Kurdistan regional government took away a couple of their licenses last year, and the fields they do have aren't doing very well, actually. And I wonder how much growth there is there. And I think there are better opportunities. So I sold, which was having made a gain of 59%, which is very nice. And what did I buy? Well, I re-entered Jubilee Platinum, which I have to do a share talk on at some stage. They have exposure to PGMs, in particular rhodium, but also they have growing copper assets, and that is potentially interesting. So I've got a 1% weighting and decent conviction, actually. I've also opened a very small position in Afritin. So this is going to be the next subject for share talk. I haven't analyzed it yet, but preliminary investigations, it looks quite good, actually. It's the right stage of the cycle. So I've got some more limit orders to see if I can pick more up, although, of course, the share price has been rising. And then I've re-entered BP on my SIP, selling Genel and Tullow and putting 2%, a 2% weighting in BP. Now, when I sold it, I had a lot of BP. I had 10%. So I think 2% is actually a more appropriate weighting given its exposure to Rosneft. And then I bought another small oil and gas company, Kistos. We'll get onto that in a second. I added to Harbour, which is a conviction trade, and I have a weighting of 4%, which is pretty much maximum weighting for me in my portfolio. And I added to Saga. Now this is Kistos, and I mainly bought some at £3.50 last week. And almost immediately after I'd bought it, Kistos came out with this value creation plan. Now, we like examples of egregious management self-enrichment schemes, but we generally like them to be an amusing anecdote that happens to other people, not to companies that we actually own. And Kistos have come up with a corker. So executive chairman and founder Andrew Austin actually owns 17.25% of the company. And this week, they came out with this value creation plan in which the executive team, of which he is a member with 36% of the entitlement pool, will receive 15% of any excess value created by Kistos if the company returns over 100% over a 5-year period starting in May last year, which is a really convenient starting point because the price then was £2.42, and the price after a 10% drop because of this is £3.32. So the share price doesn't have to rise 100% to cause this payout. It only has to rise 46%. And if the oil price keeps rising, they have to do nout to get a very nice payout. Thank you very much. But you'll be relieved to hear that through the kindness of their hearts, they have capped the maximum each of them could make at only 25 million. So there you go. There is the principal agent problem in action. Shareholders find it very difficult to hold management to account, and they can try and foist these outrageous self-enrichment schemes on us poor investors. And bear in mind that Mr. Andrew Austin owns 17.25% of the company. And if the share price were to double, he would make 34 million. But that's not enough for him. That doesn't motivate him. He needs more motivation in the form of a value creation plan. Richard, I can see you want to say something.
No, you're hostage to fortune, aren't you, Keith? There's nothing you can do about it as a small investor. It is one of the risks of investing, and it's and of course there's no know it's going to happen until it happens, and bang, there it is, and you unfortunately caught.
Well, to me, this is
set your own company up and do it to others, do unto others.
Yes. If only we had some revenues, Richard. We
need just an oil under your back garden. I'm sure there is.
Yeah. Well, anyway, I take this as a sign that this company has a fundamental lack of governance, frankly.
Are you going to sell your
I am. Yeah, I am actually. Well, sometime this week I'll get round to it.
Yeah.
Crystallize the loss, just get out. Now, the other company that I bought and which I have a 5 out of 5 conviction rating is Harbour Energy. And this is the share price, which has been quite remarkably flat, given that the oil price, it sells oil, has been going through the roof. Go on, explain that to me. Revenues, profits going through the roof, share price going absolutely nowhere. Now, we did a share talk on Harbour Energy, and essentially it was formed by the merger of private equity owned company with listed and highly indebted Premier Oil. Now, one of our members on Discord, who goes by the name Miles44, not his real name, actually had a call with Harbour Energy's investor relations department this week and trying to explain what's going on. Now, and they made 2 points. First of all, that investors weren't buying the shares because they were waiting for the Tolmount field to come online, and that should happen in Q2. And also the private equity company that backed Kistos, which was the main, which did the reverse takeover of Premier Oil, their lockup ends on the 1st of April. And so they can start selling shares from the 1st of April, and investors are waiting to see what they actually do. But bondholders who got a load of equity in the debt for equity swap from Premier Oil debt, investor relations were saying all that selling is now over, and that the Tolmount field has had a load of electrical problems, but has now passed its inspections, or whatever that means. And we're waiting first production, and free cash flow break even is between $30 and $35 a barrel, i.e. at $90 a barrel, they're making out like bandits, although the share price is going nowhere. So, you can't change the share price. All you can do is take advantage of it. So I've been buying steadily more in the last few months. Okay, and that is it, I think. Richard, you got anything to add?
No, nothing to add, Keith. Thank you. I think Harbour Energy is very interesting. I do like the fact that the share price has been flat despite the increase in oil. It doesn't rather look as if it's ripe for a re-rating, unless they come out with some sort of executive director remuneration scheme.
Thanks. Thanks for putting that nagging worry in my mind, Richard. Anyway, I don't find any of their explanations for the fall in the share price or the share price going nowhere very convincing, actually. I think a lot of these things, for example, i3 Energy, which we covered in Share Talk, its share price was falling, going nowhere. And then it announced a change in its dividend policy from quarterly to monthly, and its share price absolutely shot up. It went up the best part of 40% in a matter of weeks. Now, the economics didn't change. The cash flows didn't change. They're just the interval between them changed. And the company was in no way worth 40% more. But it's just a question of the narrative. It just brought it to investors' attention and kaboom. And, I expect the same to happen to Harbour Energy at some stage, frankly. And on that cheery note, it's goodbye from Richard Wheater. Oh, sorry, before I say that, actually, please press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Kistos.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.